Good morning, everybody. Kirk Spano, August 10th, 2024, and we had a heck of a week. A week ago on Saturday, I told you that I thought that the blow-off bottom on the market might be Monday morning, and it turns out it was. The market was down 6% going into the open. By the end of the day, it was only down about 2%. The rest of the week was up on Tuesday, Wednesday, and Thursday, and about flat to a little bit down into the close on Friday, for a net up week of about 2 points. I suggested buying the dips on QQQ, which I did a little bit of in ETF accounts, and I sold some puts in some accredited investor accounts and closed those on Friday morning. So it took about a $5 gain on QQQ on the puts. And at this point, I'm back to having a little bit of cash, and my QQQ orders are still at 415. I don't know if we're going to get back down to 415, but the charts say that probably. And Shooter had a chart up this week, which I'll show you in a few minutes, that indicates that low 400s range is still in play on QQQ. And we're going to talk about a couple of things today. First, I want to start with Seeking Alpha finally got margin of safety remodeled. This is not something I control, so you can't ask me for stuff because I don't control it. But this is based on a redesign that they got from the authors, for the most part, input from the authors on how we'd like to see it done. So you'll see that the articles look a little bit different here, just a little bit wider. And the main thing that you'll notice is the coverage tab is different. So this shows current holdings or current recommendations, closed positions, and you can look at everything if you want to, right? I think you should probably look at current. Just for funsies, you can look at closed. And as wonderful as some of these are, you got the other end too. Just looking at the history, it's been a pretty good run. The thing is that I don't know that the service was as easy to use as it could have been. When I make recommendations, a lot of times they come in in hunks, right? It's easiest to buy on a correction, in my opinion. So whether it's a market-based correction or a company correction, I haven't really changed my investment philosophy at all over the years. It's evolved a little bit. I have gradually thrown out more and more and more of the things that the industry teaches you and that the media preaches to you, to focus more and more on my best stocks, more and more on the best ideas. I really have shied away from anything where I can't find that margin of safety that I think will sustain in the long run and prevent me from having permanent losses. And if I'm in a stock and I start to doubt that, I will generally sell, because if I get that spidey sense on management, which is the big one, and reading management, again, it's like sitting at a poker table and you have to read the opponents. Management can destroy good companies, and we saw that with Ginkgo Bioworks. We saw that with On Track. So anyway, this tab, this coverage tab should have everything. Just bought New Fortress Energy. I'm going to buy it again, so I'll reiterate it. We'll add a share price in the 13s on Monday. MP Materials, I'm going to reiterate it to add another lower price, and that way you can see how I'm scaling in and how far apart that I do it, right? So most of the new ones, obviously are still underwater, but as you go down, you start to get more green. Radcom, and a lot of these are super tiny positions. Quick Logic, I actually sold that, and I added to Applied Optoelectronics on Monday. That's not on here yet. I have to see if I can put it in and get it to be timely. But Applied Optoelectronics, the very next day went up 25%. So, you've got that. New York Community Bank Corp, I'm going to reiterate, this remains one of my favorite stocks. So we'll see over time, AST Space Mobile, through the roof for us. And ultimately, those winners, right, the big winners are going to be the ones that propel your overall gain. So something boring like Occidental Petroleum that we bought a long time ago and just kept selling puts on. I mean, I would think that a lot of you are really profitable on Occidental just selling the puts, and that's all I've done for a year because I had it called away at one point, and I just sell puts over and over and over again. So while it's open here in this tab, you have to understand that I'm trading options around it. So if it gets called away, I don't necessarily make that a sell in the system unless I'm not going to keep selling options on it. Yeah, Palantir, having a good experience with Palantir. We bought this real low. Now it's 30. That's pretty good. Netflix is really the only streamer that I really want to be involved with at the moment. And I will say, I'm going to do a update and clean up a lot of these positions by January, probably. And between now and January, a lot of these are going to be sold off because I really don't own them in portfolios anymore. But we never officially closed them. Like Netflix, good company. But we had a discussion about this one 3 months ago. It was at the last earnings. And I told you that they explained how hard it was going to be for them to keep their growth numbers intact without having significant penetration overseas, right? They basically said, look, the American market is saturated. And so they have to get their growth overseas. And what did they do? They started filming in other countries. So they have studios around the world now, like 4 or 5 of them. Latin America is a big focus for them. And if they can grow in Latin America, which I think they can, I like the whole thesis behind Latin America. Proximity to the strong United States economy, the dollar drifting down a little bit as a product of managing our debt, which means that you're going to have small caps do well on lower interest rates. You're going to have international stocks do well on their currencies being relatively higher. And I think that Netflix can capture part of that. Now, would I buy it today? No, I wouldn't buy it today. And that's why you have to go look at the punch card stocks lists, which you can find here. So you click on resources and you'll get your punch card dividend stocks and punch card growth stocks. The grandpa stocks I'm going to update here. Growth trends ETF, I need to do an update. But this is where the main things will be. Your getting started articles are here. I updated 2 of the getting started articles. They still show up with the original publication dates. I just went in and updated them. Made them a little easier to understand, easier to use. I'm erring on the side of keeping the articles shorter than longer. I've always tried to be a Hemingway approach guy, say as much as I need to say with as few words as possible. So, go ahead and take a look at these. I think these are important. The one that I haven't updated yet is the 4-step investing method. That's probably going to be a brand new article. I don't think I'm going to update this in the system. Maybe I will, because I like the fact that it's been using it since way back in the beginning. So I'll probably just that is what I'm going to do. I'm going to change the title and I'm going to rewrite the article because right now there's just a link in it that should go to an ETF. It does. Core 4 is actually Core 4 investing is copyrighted by somebody else, which is why I don't use it anymore. So I think I'm just going to call it the margin of safety investing method. And that fundamental trends, what I'm going to call it? The fundamental trends investing method. And it's going to be a 4-step process. So we know that the 4 steps are understand the secular trends, understand government and central bank policy, understand fundamental value at the industry and the corporate level, and then price trends, which I prefer quantitative analysis. Hard to show that to people in a picture. So we use the technical analysis and then we try to explain it from there. So expect that to be rewritten. I'll double check these to see if I need to update these. I think the selling options for income is an update of the retirement income options article. I just rewrote it brand new. So make sure you read this. This is an important one. I really want you to know how to sell cash secured puts. It's just such a wonderful way of collecting extra income, and you're sort of swing trading the market, right? You're making 2 to 3 month trades, maybe 4 or 5 or 6 months sometimes, but it's a way to capture income, generally double digits per year. If you're selling puts 2 or 3 times a year and selling covered calls maybe once or twice a year, and all that income coming in, it kind of systematically is keeping you involved, and you're systematically selling the rips in the market, and you're systematically setting up good till cancel buy orders when the market is a little low or a little oversold, but you collect income both times, right? So you can buy low and sell high systematically by, maybe a half a dozen times total per year, selling some sort of option and collecting all that income. And why do I say a half a dozen times a year? Because when you have a whole bunch of open cash secured put positions, you probably don't do anything the next month, right? Unless something expires. So you're recycling your cash by collecting income against it. People ask me about the money market rate. I don't care about the money market rate. It's going to be what it is. If I can make 10, 15% a year in premium income, yeah, whatever I get on the money market rate is gravy. But it's that 10 to 15%. And I think a lot of you generated over 20% in the last year on selling option premium. So in a day and age when the millennials and the Gen Zers, they are active in the options market and they're taking less leverage, right? They're not using margin as much. When interest rates come down, that'll change. Margin will go up, set us up for the next big correction. And I told you about this in 2018 or 19 that it was coming with options. Remember, I went to New York and I went to the Traders Summit. I can't remember if it was 2018 or 19, but I talked about it way back then. So for those of you who've been with me that long, there was a conference and there were some of the best speakers in the world that couldn't fill up a room with 60 chairs. But the big event halls that were talking about Bitcoin and talking about options trading and futures trading were packed. 300, 400, 500, 600 seat auditoriums. I don't know how big they were. They were big, right? Those foldable walls, they had them all folded out and the whole room was full. I knew back then that we were setting up for people trading options and futures. And that's good for me because I know, those markets inside and out. I don't trade futures because it just doesn't fit in with the retail aspect of my business. And that's why you should be watching Forex Analytics, even if you don't trade futures. The Forex Analytics program is pretty awesome. So I did this interview on Tuesday morning, and I suggested that you go here and like it. It's a good interview. And I was pounding the table starting Saturday and all the way to Tuesday morning by the dips. And, we'll see if anybody listened. But this Forex Analytics, I would follow this. You don't have to pay anything. Just follow them. They have a morning show, but you don't need to be on in the morning when they're talking. You just want to basically listen to these interviews, and they have a whole channel of stuff. So Dale Pinkert is the guy who helped train Shooter, and he does interviews every morning. And then they have other things. The Flow show is kind of interesting, talks about the movements in the market, then the face interview. And then they also, what else they're watching. So it's a good channel. I would subscribe to that. All right. So in the about, hey, yay, about, and some of these are my tabs, so you don't see those. But the coverage and the resources, as I said, I'm going through updating everything. The 4-step one is going to be the one that I update next. All right. So what's going on in the market? So by the way, we've had a good, I updated the chat room too. So the main chat room is questions and answers for Kirk and Teresa plus member discussion. The more mosey is when you find interesting links that are maybe just a little bit, more in-depth reading to do on your own. Les is very active there. A few other folks. The options mosey, I made that read only. So what I'm going to do here, because typing up an options article in real time and then taking the time to put it out there, it's too much. So when I make a trade, I will try to post it here as quickly as I can, and I'll put the little at all so that you get a notice. So one of the things you want to do with the chat rooms and with your membership here, right? Manage your email alerts. You want to make sure that you're getting email alerts from me. I don't know if it's here. You have to figure out where it is. I don't know which one it is, but you can, when you follow me, I won't be able to follow myself, but you'll normally have a follow button for Kirk Spano. Go ahead and follow that. And then there's some setting for margin of safety. You want to make sure that you get the get the notifications. Maybe it's here. Settings. Yeah, it's in here. You want to make sure that you get, oh, there you go. So in your notifications or in your subscription here, receive alerts from the service via email and push notifications. You want those, right? So you make sure that you're getting my notifications by going into your profile, your subscription settings, right? And then under this subscription, accept the email alerts. All right. And you can do the same thing with this. Make sure that you're getting the alerts, enough of that. So what happened in the market this week? The big thing was an unwind of the carry trade. And what that is people who, hedge funds, typically in big institutions, they borrowed in yen, right? Because they can do that. I mean, we're not doing that. But they borrowed in yen at zero, right? They're able to borrow money for no cost from the Japanese. And then they invested in places with a higher yield, or they even, in a lot of cases, bought stocks or futures on commodities. And those are more risky trades. It's one thing when you borrow at zero and then you just, then you invested in a bond in the United States at 5, right? As Japanese interest rates go up, and I think they're at a whopping 0.5% now, something like that. But the dollar interest rates come down, it becomes a less attractive trade. And the weird thing is because they're all using leverage, this is where the leverage in the market is. They're borrowing and they have to pay back on the one side. And if they suddenly are at 5-to-1 leverage or 10-to-1 leverage, in a lot of cases 20 or 30-to-1 leverage, they run into problems, even with small moves in interest rates. And the reason is because they lever up as high as they can go based on the current conditions. Well, when the conditions change, they have to undo the trade and take their loss. So don't worry that they've all lost money. What they did is they just gave back some of what they made. And that led to a lot of forced selling, led to a spike in volatility already coming down. But the forced selling is pretty much exhausted. So JP Morgan on Friday said that there was an unwind going on Monday. And on Friday, they said it was almost half done by the end of the day. Forced retreats published late that day. And then on Monday, at the end of the day, they said it's about 3/4 done. So over the course of the week, you've probably had most of the rest of the carry trade stuff undone, or the forced selling just ended because they had the pocketbook to say, I'm okay with the current situation. So could there be a little bit more sell-off? Sure, we could get another day like Monday at some point, and that would probably be the end of it. What we know is that from a leverage standpoint, a lot of that leverage wasn't, and I've been telling you this for years, the margin and the leverage in the markets isn't as high as it was back during the financial crisis. We're just not set up for a financial crisis. I'm not saying that it's not coming. I think it is coming, but I think it comes after interest rates are much lower and a lot more people start to use margin. One of the things to keep in mind, and I talked about this about a year ago, is the private credit markets. They stepped in when the banks started to lend less because the interest rates were going up and a lot of banks got caught off sides with the interest rate changes. I know, I'd have to count, it's 11 or 12 bank executives I know. And a couple had problems at their bank and they had to, rejigger things. And they blamed the Fed. Oh, the Fed didn't tell us they were going to do it this much. Well, we know that the Fed was telling us. People just ignored them. And there was a common trait with the two executives that said that it was the Fed's fault that things got goofed up, and it was very ideological in nature. So they let ideology get in the way of their investing, which is something that I've warned you about. People who know me know that I'm a pretty centrist guy, a little to the left, a little to the right, depending on the thing. But if you're very liberal, you think I'm conservative. And if you're very conservative, you think I'm liberal. So, and it's been that way since college. I mean, I wrote an article where both sides criticized me because the liberals didn't think I was liberal enough. The conservatives didn't think I was conservative enough. And if you're not conservative enough, you're liberal. And if you're not liberal enough, you're conservative. Whatever. I don't care. 60, 70% of us can reach the middle with a handshake. And those other 30% of the people, I shrug my shoulders at, and they're loud, but hopefully they don't get control of everything, either direction. In any case, what we can see is that the forced selling is pretty much done. Could be a little bit left, but not much. So what we want to do is continue to stick with first principles and understand what's going on in the market. And what we know is that earnings are finally starting to go up. I guess that didn't help much. Earnings are finally starting to go up, and the realized gains or change during earnings days have been drifting up. So the market's becoming more reactive to earnings. And that's interesting because for the last couple of years, stocks went up based on an expansion in valuations, right? The PE ratio was going up. So the P was going up, even though earnings have been flattish for about 2 years. Now the E is going up and the PE ratio at the moment is contracting, right? It's coming in because prices have come down a little bit. So the E goes up, the P comes down or stays the same, which means that the price to earnings ratio contracts. What I would expect is this, is as liquidity enters the market especially, and earnings start going up quarter after quarter across the broader market, you're going to see higher stock prices into at least the end of next year, and we will find out how taxes will impact some selling maybe at the very end of next year. But if we get a sell-off in, say, December of next year or November, or late in Q4, it'll be temporary. And then January will just kick it back into gear until we get to a point where leverage and margins run face first into some economic problem. Maybe the last boomers getting on Social Security and Medicare. So there will be some convergence of events eventually that cause a very big sell-off. Your 30 to 40 or 50% bear market. I just don't see it for 4 or 5 years, 6 years. The round end of the decade sometime. 2029 is the year that I keep using. Could be 28. Right? Markets sometimes are ahead of themselves. Could be 2030. Sometimes markets are a little behind themselves. Who knows? But for now, what do we know? We know that the Fed and the Treasury are adding to liquidity. They just started, and you're probably going to see a lot more liquidity over the next year. And again, we have to keep thinking about, okay, does the Fed suck? And I know that's the popular motto. I think the Fed's been pretty darn good. I think they had a reason to print all that extra money during COVID. It was two-legged there. One, they weren't sure how bad COVID was going to get. And two, if they could devalue the debt and mitigate the boomer crisis at the end of the decade, then fine, right? Then they were just helping the future. And I think that's what they ultimately did. I think the CHIPS Act, I think the Infrastructure Act, and I think the Energy, aka Inflation Reduction Act, which in the long term it really does end up being, all added to the transitory inflation that we had. Clearly it was transitory because it's gone now. 2 years of inflation, everybody's like, oh, longer for higher, higher for longer. Well, turns out it wasn't higher for longer, and I should have published the article that said higher for longer won't last long because I have it in the queue. Never published it, but you've heard me talk about that over and over again. So inflation has never really been the boogeyman. It was a party crasher at the deflation party. And, now we're going to get back to the point where we turn back to disinflation, which is super low inflation. And we'll have the talk about deflation again in coming years, probably towards the end of the decade. And I want to just keep going back because I know that I say it in passing. Think about the private credit markets where you have hedge funds and private equity doing the things that banks used to do and then packaging it and selling it to everybody else. What does that remind you of? Who was an investor back in 2006, 7, 8, 9? Who saw the Big Short? So what they're doing is they're bundling up all these loans that rather than happening through the banking system, happen through the private equity markets and institutions, mainly hedge funds, that maybe aren't the best loans in the world, but they're selling them to individual investors. And I would really warn you, that if you are invested in BDC companies, business development companies, if you are invested in companies that have an underlying private credit portfolio, closed-end funds that are in these markets, you better think twice, because there's going to be a crash there. And when that crash comes, it's going to be a big deal. It's going to be a very, very big deal. And it'll coincide with the peak in the boomer retirement, probably, give or take, because the private credit really started kicking in last year and a half ago, 2 years ago, right in that range. So let's say starting in 2022, but really starting to peak now. We know that most loans that they're dealing with are shorter term in nature, similar to the commercial credit, which runs on 5-year cycles. So let's say that private credit is probably set up to have big problems whenever the next recession hits, which probably is 2, 3, 4 years off. But if it happens to coincide with the boomer retirement, everybody's going to point to the boomer retirement. Oh, look, it's them breaking the system, right? So the finance guys will say, no, it's not us, it was them. And we're setting up for a perfect storm financial crisis near the end of the decade because of the private equity and the private credit, the business development corporations, the closed-end funds that are doing dumb things, and it's going to be a problem at some point. And at the same time, we haven't figured out that we need to actually pay for the boomer retirement rather than, pretending it's not there or threatening to get rid of it, right? I mean, the whole tightening up on Medicare and Social Security blows my mind that politicians even talk about that, because the money that you and I have put into Social Security has gotten a subpar return the entire time. The only time that you make extra money on Social Security is when you don't take it at your full retirement age and you hold off until 70, or I think now you can hold off till 72. And during those years, you get 8%. But all the years prior to that, you're making almost nothing, because they don't really put the money into treasuries where you should at least get a treasury rate. They don't put the money into the stock market. I would argue that a quarter of the money going into Social Security should be in index funds. And really, it's kind of a pension that's underfunded by tens of trillions of dollars. The idea of cutting it even more, right, to cut the payout because they didn't handle funding it correctly, in poker, my poker league at home, you know what we call that? We call that a dick move. Yeah, that's a dick move. And we'll see if enough people vote to have their own Social Security pension cut, to have their own Medicare healthcare benefits cut because of the government, because, these guys have special interests that they're beholden to, didn't fund it properly. They had decades and decades and decades to do it right. Al Gore was 100% correct when he said do the lockbox. We still haven't done the lockbox 24 years later. It was the right thing to do, and we did not do it. So the only ways to fight off the big bad thing that's coming is to increase liquidity. And what we're starting to see is that the treasury auctions are becoming a little bit more challenged, because we just had this big boom of foreign direct investment. And now it's probably going to, ebbs and flows, it's going to ebb off. And that's why the Treasury, which we talked about last week, is increasing their buyback program from $15 billion a quarter to $30 billion a quarter. And it's going to be $100 billion a quarter by next year, I think. So they're going to keep adding liquidity to make sure that the Treasury auctions don't have a problem. We know that when the repo market had a problem in 2019, that the Federal Reserve created a facility and funded that market to the tune of $1 trillion. And now they have $1 trillion slush fund to support these markets on top of what the Treasury is going to do. So you have already allocated $1 trillion for a repo market problem, and you're putting $30 billion a quarter into the Treasury auctions, and that's going to go up. By next year, maybe the year after, I think that we're going to start going from QT to outright QE again. And they're trying not to call it quantitative easing. So whatever name they give it, that is what it's going to be. And whether they do it through special facilities or Treasury auction buyback programs or refunding, whatever they call it, It is quantitative easing. The quantitative tightening is in name only. We know that the money supply just started to go up again. I've shown you that chart before. And so the only way, and this is the first principle to keep in mind, that is likely, and the second one is the austerity, that right, there's two ways to make things work. Austerity and have a nice 10 to 15 or 20-year depression. Okay. If you want to vote for a depression, you go ahead and vote for a depression. I'll get rich taking your money. Now, hopefully you get rich and we'll take somebody else's money, right? But if the country votes for depression, and I believe, and I said this on Forex Analytics, I believe that the Trump trade is stagflation. And I believe that the Harris trade is decarbonization. So we'll see which one we get. And, I don't need to belabor the point too much more. But if we vote for depression, right, then it's a big short trade that 2% of the people will try and the 0.5% of the people will get right. Read this real quick, right? So this is what happens. If the dollar gets too strong, and I've told you about this, things break. If the dollar gets too weak, what happens? Things break. And I've showed you my dollar chart, the millennial dollar. DXY has to hang out around 195, right in there. It's got to be close to par and things work. If it spikes up or it spikes down, you get a crisis, just a different type of crisis. Spikes up, right? You get deflation. Spikes down, you get inflation. And if trade breaks, you get a recession. And usually trade will break. So you can either have stagflation if the dollar plunges, and you can just have, a run-of-the-mill recession if the dollar surges. Either way, not good for markets. What we know is that liquidity is probably the most likely thing to happen, right? QE, by whatever name they call it, is probably going to happen. How do we know? Again, how do we know? Because they're already doing it. They are already doing it. One of the things on Wall Street Week this week, we had Larry Summers. And sometimes he's worth listening to, other times he's not. But they asked him, and remember, they're trying to get to a pretty sophisticated crowd. They asked him, said, look, Donald Trump said that he wanted to have influence over Federal Reserve policy. And Larry Summers laughed at him. He goes, look, here's a guy who probably doesn't understand economics terribly well, right? He was a real estate developer. It turns out that he would have been better investing his money in the S&P 500 and living his life as an idiot son on a beach, which kind of he does. And he would have done better by not handling his own money. So what makes you think he can handle the money of the country, right? In a lot of countries around the world, the central banks have become independent. Why? Because politicians have a conflict of interest because they will use the financial tools, the monetary policy of the central bank, and create bad situations, right? They'll spike things and then crash things, which is what I think Trump would try to do. I don't think he'd pull it off, but he'd try. And when you see hyperinflation in other countries, it's because these dictators or wannabe demigods, they use the monetary system and they break things because they just don't understand what they're doing. They don't understand the big macro picture. They might understand the micro of the business that they were in, but they don't understand the macro. They don't understand how all these moving parts work together. So as a trained economist who went into finance, a lot more experience managing money than I do studying economics anymore, but until I was in my 30s, that's all I did. You can see that when you apply reflexivity, right, the ebbs and flows and the snaps, right, the peaks and crashes, the snap, the pulling the rubber band and then, right, that's reflexivity. George Soros wrote all about it. Read his books. You get these huge reactions. And if somebody comes in and messes with the dollar, messes with the monetary system because they want to juice it to look good, it just leads to a crash. Maybe the crash happens while they're still in office. Maybe it happens after they're gone and they blame the next guy. And in America, what is happening right this minute is the fault or credit of whoever's in office. It has nothing to do with 2 years ago, which in reality, it almost always has to do with 2 years ago. So we are going to get more liquidity. And in that situation, I agree with Grumman, even though he doesn't think the Fed does a good job, but I do. Even though he looks at it as an Austrian economist, I look at it as a Keynesian kind of Chicago school, right? There's different schools out there in economic thought. And when the different schools of economic thought come to about the same answer, it's probably right. Or everybody's wrong, right? But it's usually right. Every now and then everybody gets it wrong. So we're probably going to see gold go up. But again, I think it's hard to trade those securities and Bitcoin go up. Now, I want to focus a little bit on Bitcoin right here because there's an idea out there, a narrative that just got floated that the digital gold thesis was undermined by the crypto sell-off. I haven't used this word in a while, but you know that I used to live near farms, and I'm trying to get back out there. What word am I about to use? What kind of a trader's narrative is this? 8-letter word? Hey, yeah, there you go. Farmer's word. Got a couple people got it. That's right. It's bullshit. Bitcoin is every bit digital gold. And we had an unusual, and I've been talking about this for a couple months, we had an unusual supply of Bitcoin hit the market, right? We had the Mt. Gox settlement, which was tens of billions of dollars. I think it was hundreds of billions. And we had the confiscated Bitcoin in Germany. I think they sold 3/4 of it. And they stopped right at the end because one of the German politicians was like, should we really be selling all this off? So I think they kept about 1/4 of it. But we had all that Bitcoin hit the market in June and July. At the same time, we had a liquidity-driven sell-off because of the carry trade, right? Multiple things hitting at once. The market can handle almost any one thing. But when you get 2 or 3 things all kind of happening at the same time, or the financial crisis where you had like 8 things all happen at the same time, worse things happen, right? And when that feeds into popular psychology, everybody's like, I'm scared as hell. I'm going to lose everything. Then it spirals. And it happens once in a while. It happens to every generation, sometimes twice. The boomers might get lucky and they might get it 3 times. But, the reality is that Bitcoin is still digital gold. It jumped right back up the day after this article, right? It went up $10,000 last few days. Think about this. A record amount of liquidity went into the supply of Bitcoin, just as a big hunk of liquidity was coming out of the markets in general. So pushing in supply, pulling out demand, it caused prices to go down, right? Right. Supply demand curves, right? Things are moving. That's all it was. And I would want you to consider that we didn't see a 30, 40, 50, 60, 70% crash in the price of Bitcoin, right? Actually, it got to about 25%, right? Dropped about 25%, give or take. Run-of-the-mill bear market, right? A cyclical correction. I think that's all it was. Could it double dip? Could it double bottom, triple bottom? Absolutely. However, and if it does, it's over the next few months, I think. As liquidity gets put back into the market, as you have more and more institutional and sovereign buyers. The sovereign buyers are super important. As we've talked about, first principles here. If sovereign nations are buying Bitcoin for their balance sheet so that they can have it as a currency hedge against the dollar getting too high or too low, in an emergency, or as part of their trade policy, part of their relations with other countries, they use it for part settlement of big transactions, oil, wheat, things like that. It's becoming part of the international currency system. What are you really seeing with Bitcoin? This is the birth of a global currency, is what it is. And it is serving a similar function as the gold that sits in vaults all over the world for really no apparent reason, because they never take the gold and send it anywhere, right? If they put gold on an airplane and it goes from one country to another, that's big news. It's all just accounting entries. There's all sorts of gold kept at Fort Knox and in London and in Switzerland and in a couple dozen other places. They don't ship that gold back and forth. They just say, oh, you owe us some gold. And then a year later, oh, now you owe us some gold. Did it balance out? It's close enough. Okay, so someday you'll owe me gold, someday I'll owe you gold. But we're never really going to send it anywhere. Pretty rare that they do. So why not have a digital version of that? If you're not really transporting the gold, and it really doesn't do anything, and we're not making enough cell phones to use it all, or wherever else we use it for, jewelry. I mean, honestly, if they used all the gold in the world to make jewelry, man, we would all have the craziest Mr. T style, toolkit necklaces around our necks, right? Maybe the greatest Xer thing ever. So this is bullshit, complete and utter bullshit. And if you're not buying the dips on Bitcoin to get to the allocation that you want, which should be at least 5% in my opinion, and you can be much more aggressive than that if you want to, I think you're missing the boat. Mark Cuban talked about Bitcoin recently, and he actually said it's going to get well into the six figures. He talked about it exactly the way that I've been talking about it for 2 years now, 2.5 years now. When folks like that, who are billionaires, start to talk like that, it means two things. One, you might be right. Two, it means during the prior time period, they probably were accumulating Bitcoin. Elon Musk was positive on Bitcoin again after shutting his mouth for a couple of years, right? You know, Saylor is all over it. So you take a look at some of these guys and you go, okay, why are they backing this? And it's because rather than having the president in charge of the Fed to control the Fed, you introduce a currency hedge. It's a check, right? Checks and balances. Fed loses a little bit of power because Bitcoin is out there, but because the United States is a pretty big holder of Bitcoin, it's still good for us. You know, they're talking about having a Bitcoin reserve. It exists. They don't call it anything. It's just there. All that seized Bitcoin that the government holds right now, it's something like 60-70% of it should go back to people. The rest of it was taken from criminals, and we'll keep that. They haven't returned a bunch of Bitcoin to people who it was, you know, somebody had it stolen from them, and then the government retrieved it. Government got it back. But the government hasn't given it to the original person. Why? Well, there's a cost involved in retrieving it from the criminal. And historically, assets that the government retrieves, like if the FBI gets something back from criminals, they don't go and hunt down who it belonged to originally. And you can file a claim, say, hey, that was mine. And sometimes they will give it back to you minus a fee. It's like a restocking fee. And I think some of the Bitcoin that'll happen with. But otherwise, they auction it off, right? You get those ads in your email box, FBI auction or government auction. Those are real. If you've ever been to one, they're pretty neat. And I think, right, this plays into the German Bitcoin that went into the market. I think that you're going to continue to see governments find ways to, maybe not always on the up and up, keep Bitcoin that they came into possession of. So you have governments getting more involved in Bitcoin around the world. The OPEC, right? The richest countries in the world, OPEC, they're buying Bitcoin. Russia, China, United States, little countries, several African countries, El Salvador, Argentina. If it's not smacking you in the head yet, get smacked. All right. What else could cause a big problem? I didn't, did I let my subscription? Okay, yeah, I'm good. Thought my foreign affairs subscription ran out. This is one that I've had for a decade at least. Foreign affairs, China's real economic crisis. It is worth the subscription just to get this article, I think. It's a cheap subscription. So I haven't talked about foreign affairs in a long time, but I do read it every month. Well, it takes me 2 months to read it because I get the paper copies and I read the paper copy, and they only come every other month. But this is a great website, and the thought exercises that are in here are pretty incredible. If you really want to understand, read articles like this. So in China, we know that for a very long time, you had a buildup of local debt. But at the federal level, they had big surpluses. Well, because of first Obama and then Trump and now Biden, we have been slowly putting the screws to China to try to control their industrial policy. And their industrial policy is, 10 times what ours is. What is industrial policy? It's when the government puts their thumb on something, subsidizes a business for the purpose of making them more competitive internationally. And while we do that, absolutely we do that, we probably are the least intrusive in that way. So we rely more on our markets and the fact that we've had education and, markets that have developed over decades. And, we still have advantages of geography forever. And, the post-World War II benefits are still, there's still a shadow and a breath of that. So the problem that's starting to happen in China is that they are exporting, their export surpluses are coming down. Still running surpluses, but smaller surpluses. And that means less federal money. And as they bail out the localities, the federal balance sheet isn't as good. That's the problem they have. China's going to make their own decisions just like we're going to make our own decisions here. At some point, either they consume more of their own stuff or they don't recycle their money the way we recycle our money. And we'll see what happens. I suspect that Xi, being a pragmatic dude, is going to do something that encourages a little bit more consumption. And if he's smart, he'll do it in a way where he's simultaneously using the problems in the real estate market to create liquidity in the rest of the economy. How could he do that? Well, what he could do is say, look, we have all this inventory of property that nobody lives in, and it's just deteriorating. He could give a lot of that away, sort of the way that Italy gives away buildings for $1 if you promise to fix it up. So if he says to the Chinese, hey, we'll give you property, but you have to, the 50% that you normally would have to pay as a down payment, you're going to put that into a loan, and you are going to get the property, and you can have all that money back if you put it into repairing the property or upgrading the property. So think of it this way. They have a $100,000 condo, a $100,000 house. So usually a condo, right? They built a lot of big buildings. You buy this $100,000 condo or $200,000 condo for $100,000, and we will let you use $100,000 to fix it up. You gotta go and maybe pay directly to a contractor, which means they have to police the contractors because they'll lie, cheat, and steal. But there are ways for them to increase people's standard of living basically for free. The money gets recycled. You get the the amplification effect of a transaction. I pay you for something, then you go pay somebody else for something, then you go pay somebody else for something, right? Usually there's 5 or 6 transactions for every dollar. Velocity money is very low right now in the United States, been coming down for a long time. Mainly this is because of the big companies taking over the economy. As small companies start coming back up, and I think that's going to happen, I've been waiting for it. As boomers retire, you're going to have all these small pieces of property available cheap. Entrepreneurs are going to finally be able to be entrepreneurs and small business owners without an onerous real estate overhang, because small real estate and commercial real estate is really not going up in price anymore. I told you I missed on buying a strip mall, and I kicked myself for it, but I'm going to get another chance, because a lot of these properties that are a little disjointed, right? They're maybe not walkable. As the boomers, leave, they're gonna empty out, and you'll be able to buy a whole strip mall maybe. Now, I have a friend who just bought a strip mall, and he's tearing it down, and all but the Ace Hardware, but tearing down the rest of it, building a whole new thing, residential development, with some restaurants and shops on the ground level. And I think I'd love to be involved in something like that. I think that there's going to be a lot of that going on over the next 10, 20 years. People will come to understand that the population in the United States is going to keep going up by a few million people a year because of immigration. And you can create mini towns within a city that are walkable and have all the basics, right? You have a little grocery, you have a few restaurants, you have, a couple of QC shops and art galleries and whatever else it is that people want. China needs to make that decision if they're going to figure out how to do that. I think they will. I mean, they can see it around the world. I mean, I don't know why they would choose not to, other than maybe ideology gets in the way. Maybe pride gets in the way. We'll see. But China should have another echo boom. They should have an echo boom for what they just had. And they just have to decide to have it. We'll see. But if they don't, over the next several years, which could coincide with the private credit problem that's developing and the boomer retirement that's coming, maybe this will be another one of those things in the next perfect storm. We'll see. All right, I'm going to call it a day. Like Teresa, I am dealing with some tough stuff. My other grandmother, the one died about 1.5 years ago at 94. Just had the 95th birthday party for my other grandmother a few months ago. She just came home from the hospital. She's now on, went from hospice to palliative care. So basically end run. So we've been told if you want to visit to do it today or tomorrow, because probably a funeral coming up. So I will get a couple of things out this weekend. I don't know what the schedule will be. However, I do need to put out a global trends ETF. I'm going to do an earnings dump for stocks of the week, along with some option trades. You should really be looking at New Fortress Energy and MP Materials, right? We got that first nibble in about 4 weeks ago, whatever it was. I think that this is a big enough drop that you get into both of them, get it up to half positions, and And there you go. The traders' narratives around both of them are wrong in the intermediate term and probably even more wrong in the long term. But in the moment, right, people are, oh, look what just happened, rather than look in the front window, front windshield, and see what's coming. So try to look 2 years out, 3 years out, and you generally will come off very well for it when the traders are able to drive a narrative and push things down. Buy the dips, it works. And remember, not teeny tiny dips, but when you get a good dip, take a scoop. All right, everybody, have a good day.